Hey folks, welcome to Quantsapp. Today we will understand about debit spreads, credit spreads, and the iron flies. Like in what are debit spreads, what are credit spreads, what are iron flies, and in what market conditions, which strategies suit the best is something what we will understand in today's video. First, we will understand what these strategies are, and then we will learn in what market condition which strategy would work the best. So let's start by understanding the strategies. So let's say options architect. So you can navigate to the architect tool from the link in the description box below. And here you can analyze any of your option trading strategy very easily. So first we will understand about vertical debit spreads. What are these? These are strategies which are built with combination of calls and puts. So if I'm going ahead and creating a bull spread, that means what? I'm going ahead and creating a bullish strategy using call options. How I am going to achieve it? Simple. I will buy a at the money strike price call option or a in the money strike price call option, and I will sell the strike price which is higher than the bot line. That means if I have bought 19,500, I will sell 19,550 or greater than that. Okay, I will not sell a smaller strike price because then eventually my delta effect will play negative to me, right? Because I am going ahead and creating a bullish strategy on a much more higher delta strike price. So say for an instance, I have bought 19,450 strike price call option. So for me to convert this strategy into a bull call spread, I need to choose strike prices above 19,500, either 19,500 or above that. So now let's say I am creating a strategy using 19,600 strike price call option. Now what I will do, I will sell this call option. Okay. But before that, let me just show you the Greeks of these option trading strategy, which is a long call. Over here, you're paying theta of 682 rupees. That means if nothing happens in the market, but the time is going to pass away, right? So 680 rupees is something what you are going to pay eventually to the market just because of passage of time, which is the theta decay. So to reduce this theta decay, what we are trying to do? We are trying to go ahead and sell one more call option so that my theta decays from both my legs, from my bought leg as well as my sold leg. But over here, if you see, my theta what I'm paying is 467. It eventually got decreased, right? So the thing is, where I was paying, let's say 100 rupees theta using a bull call spread, I can reduce it maybe to 40 or 60. So depending on the market condition and the strike price that we are selecting. So now this is the bull call spread. So what is benefit of this strategy is that this strategy will not keep you exposed anywhere. It will not give you undefined losses, right? So you will not lose a big chunk of your portfolio in here. Wherein if you see on the top as well, it is giving you a flat curve wherein this will not give you undefined profits as well. But the best part is if you see this strategy maximum, it is giving me a loss of roughly around 3,000. But when I'm making a profit right now, as on whatever the strategy I have built, I have bought 19,450 and I have sold 19,700. Still, it is giving me a max profit of 9,500. So, if the market goes to 19,700, I'm going to make a very good reward to risk. So, using bull call spreads, we can go ahead and play around with our bullish views very easily. The same can be achieved for the negative side trades as well, but using put options. Simple, buy at the money put option or an in the money put option and sell the strike price OTM put option. Okay, and that will create a bearish strategy for us. So the only thing you need to do is just create a bearish strategy using put option, buy one and sell the other one. Okay, buy ATM or ITM or ATM and sell the OTM. Right. Now coming to the credit spreads. Now how we will build credit spread is, what we will do is, for the first instance, we will go ahead and sell the call option. Okay. Now this is the bearish strategy what I have created. Now on the other hand, what I'll do is I'll go ahead and buy out of the money strike price call option. So something like this. Okay. And this will be converted into a bear call spread. So now what is the benefit of this strategy? That I have created a bearish strategy using call option. So net I am credit. Okay. So over here I am on the receiving end of the premium. Despite I am not selling any naked option, I am hedged, completely hedged in this strategy. I am not making any undefined loss out here. So if you just see the Greeks over here, the theta has become positive. But this is a bearish strategy. We can create a bullish strategy using put options. I'll show you that. But over here, if you see, the theta is positive by 467 rupees. So it is a rotated image of a bull call spread. So first we build the same strategy, but it was vice versa. That time that the strike that we had bought, we have sold here, and that time the strike we had sold, we have bought here. So it is creating a bear call spread. The idea is simple, that you want to monetize the theta decay which is happening in the market. Now this is for the bearish strategy. We can create bullish strategies as well. So let me just show you a custom strategy. What I'll do, let's say put option, and select a slightly in the money put option, let's say this one. Okay, and sell this. So this is a short put, a bullish strategy. Now what I'll do is, to hedge this, I'll go ahead and buy a out of the money put option, because again I don't want to take an undefined loss in any given scenario. So this is a bull put spread. Over here we have created a bullish strategy, but we have created that using put options. So I am net on the receiving side of the premium, so it will be called as a credit spread. So if you just go through Greeks, so if you see over here, you are receiving theta of around 50 rupees. This strategy will give you more theta decay as you head closer towards the expiry. So debit spreads, when you are a little bit far away from the expiry, would do good because the theta will not be decaying very fast. Credit spreads will do good when we are closer to the expiry, because the theta is decaying faster. You will be receiving additional theta for every passing day. In debit spread, if you do those near the expiries, they will not give you any theta benefit, as in they won't give you any returns over there. Obviously the theta will be decayed, and it would be reduced compared to a long call if you use a debit spread. But talking about credit spreads, if you do this closer to the expiry, you will net receive the theta decay. So now coming to the last strategy, which is iron fly. So now it's very simple. What is an iron fly? So it's very simple. What we do is, we go ahead and sell ATM straddle. I'm going ahead and selling ATM call option, and I'm going ahead and selling ATM put option of the same expiry, obviously, and same strike price. This is a short straddle. Now the problem with short straddle is huge margin that you would end up paying, and second thing is undefined losses, and here there exists a gap risk. That means if market opens tomorrow directly at, let's say, this level 18,900, just a random example, but let's say if market opens here or somewhere here, then you would end up getting trapped in this option strategy. So what we will do is, we will go ahead and hedge this strategy. How? By going ahead and buying call and put option of OTM strike prices. So let's say 20,000 ka call option. I am buying it in order to hedge this. So on the upside, I am hedged now, and on the downside as well, I will hedge this option strategy, and everything you will do in the same expiry. And on the downside, I'm hedging this by 19,000 put option. Okay. And yes, that's it. This is short iron butterfly, also known as iron fly. Over here, why we are doing this? When we are expecting some kind of range bound movements to happen in the market, that there will be no movement in the market is what we are expecting when we are creating something like this. Best part is that you will not still be exposed to undefined losses out here in this option trading strategy. Talking about the Greeks, so almost most of the things would be neutral, but the theta decay is still giving you some returns out here in this option trading strategy. So now, when we are closer to the expiry, right, that times if I am playing with the directional view, I can go ahead with a bear call spread or a bull put spread when I'm closer to the expiry. When I'm far off from the expiry, I can go ahead with something like a bull call or a bear put spread. Okay, and if my view is range bound, so it doesn't matter where I am placed on the expiry curve, iron fly is my favorite strategy, what I would go ahead with. So do check out Architect tool from the link in the description box below and analyze your strategies like a pro.